So the first section is always where we've been. And everyone felt this in December, right? Very volatile, lots of zigs and zags. This is just December. Look at all these days that are more than 2% negative. There's a 3% negative day, a big almost 5% positive day. You remember December? Zigs and zags every day, crazy, right? Okay. January 2018. Do you guys remember what I talked about?
Yes.
What? What did I say?
It's going to get volatile.
Right, it's going to get volatile. But why did I say that? Because I was smart and I knew volatility was coming? No. Because we had just had this. We just had the least volatile year that we could possibly have remembered. And we then anchor in that's real volatility, right? And then when real volatility arrives, we get shocked and surprised at real volatility, right? So 2018, kind of normal, right? So this is 2017. That's what we saw in 2017. This is plus or minus 1%, plus or minus 2, plus or minus 3, 4, 5. And this, you can see it right there. So the daily volatility in 2017 was dessert. It was fantastic. It was wonderful. We loved it. And then 2018 happened, and we all freaked out like that was so crazy, and how could this happen? But look at this versus this. This is those in context of the average, and this is since the S&P incepted. This is since the beginning of the S&P. This is totally normal. We didn't just go back to 1980, we went back all the way. Totally normal volatility. So when we think about going forward, we should expect normal volatility. And we shouldn't be like, oh my goodness, it should be just normal, okay? So also 2018, not just volatility, but it brought the reverse of 2017. The blue is the positive. This is 2018, the negative, right? So we saw downside 2018. We haven't seen a down year for a long time, since 2008. So that was scary. Did it scare you? Okay. John, we didn't get many phone calls. We didn't get a lot of people calling concerned. There's 2 or 3 of you that I know who you are and I call. But not many people called us. So I just want to say, if you are nervous, if you are scared, that's kind of why we exist. Call us and we'll talk about what's going on. The story doesn't really change much, as you'll learn over time. But you should call if you have that emotional response. We are behavioral advisors. That's what we do. Okay. People laugh at that. That's a fact. Okay. So every sector was down except for healthcare, utilities, and consumer discretionary. So broad down. Everything else was down as well, but this is we want to spend a little time here because of these two. So this is international and emerging markets. Okay. We've talked about this every 6 months for about 4 years. What position have we been building? We've added to international and emerging markets a little bit here, a little bit there. And why? Why are we doing that?
We expect them to go up.
Partially because they're growing faster. The GDP is going to grow faster. It's also because they're cheaper. $1 of earnings is $1 of earnings. I don't care where we get the $1 of earnings. If I can pay a lower price for that $1 of earnings, that's what investing long-term means. I can pay a lower price in the emerging world and in the international world than I can in the US for $1 of earnings. Does that make sense? So when we're going to add to portfolios, we tilt towards international and emerging markets right now. Coming out of 2008, we were very heavy US. We had 0 emerging markets. We had a little bit of international, but we were very heavy United States. And from then till today, we've slowly paired out of US and added more international. So the scope of negative returns is unusual. According to Deutsche Bank, 89% of the global financial indices it tracks were negative for the year in dollar terms through the end of October. On average, 29% of financial markets finished the year with losses. So it was so broad and so deep that it was scary to everybody. But it was not normal. Normal volatility, but it's not normal for everything to go down together. So the feeling is that diversification doesn't work when everything goes down together. Bonds went down, everything goes down together. So if there was something different about last year, it's that the ballast that we're used to working didn't work as well. Does that make sense? Okay. We did not have a lot of exposure to Qatar. And there was no place else to hide, right? Global stock returns disappointed. I was disappointed in them. Were you disappointed in them? Yeah. Okay. So domestically, this is why we're, at the end of the year or in November of last year, if people did call, and the story we would tell them is, we have an expectation for enormous earnings growth. This is unprecedented. Remember a couple years ago we used the word unprecedented a lot? This is unprecedented. We probably saw Q4 is high teens. Never seen that before. So earnings went up substantially. And there's a lot of talk about that being because of the tax reform. And that's accurate. A huge chunk of that is because of tax reform. There's also a lot of talk about that being a one-time thing. But it does set up an incentive for future investments, new businesses. There's an advantage to having lower taxes to a company that wants to invest in product and equipment. There's an advantage with lower taxes. We had the highest tax rate. Now we have an average tax rate for corporate investments. I think the average is like 27, and we're about at that. We have 20% federal, 7% average state. I have a bunch of tax people in the room that can call me on this anytime. Okay, but this was incredible. And because of that, earnings went up, prices went down. What's that do to value? When we buy a company because we're going to own it for a long time and we want to have that earnings stream, that means the value went up. So this is a blip value rally. This is a value rally. Right? When earnings go up and prices go down, that's an opportunity. To say earnings have been anything other than stellar of late is to misrepresent what is happening in corporate America. The stock market, on the other hand, has clearly been expressing concern about a downturn in the economy. So does anyone here think, or you've read articles that said there's a recession in 2019? Yeah. I read a lot of those articles too. I don't see how it happens. There's three things that cause recession. There's a shock. That one could happen, right? There's wow, I had these all in my head earlier, now they're all gone. There's a shock, there's like a spike in oil can cause it, or financial issues. Financials are solid. The only person that we have to worry about financially is the US government. Most governments, actually. Not that it's in any kind of bad place. But companies, individuals, there doesn't seem to be a possibility for financial shock. There doesn't really seem to be a reasonable possibility for companies' earnings to go down. No real reason to think that there's a recession on the horizon. In 2019, 2020, 2021, the likelihood goes up. Okay. So this is what we talked about last year, early. You know, when earnings go up, we're going to see PE ratios go down. So December, at the end of the year, the PE ratio for the S&P 500 went to 14.4. That's below average. By January 4th, it was 14. That means to get back to average, we needed a 15% return this year. To get back to average, not to extend it, but remember this year earnings are going to go up again. Some people say 8%, 9%, 11%, doesn't matter. Earnings are going to go up again. We have a lot of upside in US markets and in international markets right now. However, this CAPE ratio is still really high in the US. The CAPE ratio is the 10-year average PE ratio. This always tells us markets are going to collapse at some point in the next 10 years. This always tells us markets are overvalued. So what I look at is not so much this. This is still a pretty frightening chart. I mean, it still says that things are overvalued. That sometimes in the next 10 years, they have to come down. But relative to the international markets are here at 13, 14. If you look at just the really low price international market, we're talking 11. So when we invest internationally at a value level, we're actually paying very low price for the earnings that we receive. Okay? And when we get into process, we'll talk about what that looks like. So after we talk about where we've been, where we are, and where we're going, we'll talk about process. And this idea of value becomes very, very important. Okay? Okay. So bonds didn't protect us the way everyone expects them to. They didn't really have any more downside in terms of interest rates, right? So interest rates have to go up. We've been saying this for years. We were very early to this. We were very wrong for quite a while. So we didn't participate in a lot of the positive upside that bonds had, but we also didn't get hurt when this happened. We've been very short on our bonds. But notice, this is the long-term 10-year. It's coming way, way down. And now this last year, it went up, and then it came back down. Probably not going to stay here. We probably have more upside to go here. So bonds are still not the greatest place to be. We're still in fixed income, but we're very short duration fixed income, which means we don't get a lot of yield. So the thing that's protecting us is not giving us a lot of yield return. Okay. So everyone's talking about the yield curve. The green dotted line, that's an inverted yield curve. And last year we had a moment of not the one that everyone counts, but a different one, yield curve inversion. So this is people, when there's a yield curve inversion, it's the most reliable indication that we move into a recession. Okay? It is. It's a very reliable indicator. However, it's got to be the right yield curve. The media will spin any yield curve at you and say that it's the harbinger of doom. We don't see it happening. And so this is another way to look at it, is when the 10-year versus the 2-year, see how close we are there? If this dips down below, and you can kind of see here, it dipped down below, recession, dip down below, recession, dip down below, recession. So that's pretty consistent. But now we have to remember that the Fed is holding the low end down, and because we're actually the only ones that low end is coming back up, the international buyers are coming in and pushing it down. So it's held down falsely, if you will. So it's not a natural environment. So short-term yields are going to be lower than the future. Inflation will be lower in the future. Uncertainty causes people to flee for the relative safety of bonds. This is the yield curve talk. And there is some valid talk here. It is something that we have to be watching and careful of. Again, it's an unnatural environment.